So good morning, everyone, and good afternoon to those in the East Coast. I'm Lindsay Zhu, and today I'm thrilled to have the opportunity to share with you my research, The New Normal, How COVID-19 Redefined the Options Market Landscape. But before diving in, let me introduce myself. I'm a student at South Pasadena High School in California, and I've always been fascinated by finance, particularly economics, investing, and accounting. And I want to take a moment to give special thanks to my mentor, Clay Wagar, and publisher Ray Champlin for guiding me in my research journey. Benjamin Graham, the father of investing, once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This means that short-term investing is often driven by speculation, while long-term investing focuses on fundamental value of the assets. This analogy perfectly reflects the two primary behaviors I observed in the options market. I will be first going over the background information, then the aim of my researches, findings, and finally the big takeaway from my research. In 2008, as the S&P 500 plunged by 50%, market volatility spiked. As shown in the chart on the left, the index fell from 1,200 to 800, while the VIX, an index that tracks market volatility, soared to around 80. Similarly, options trading volumes surged during this period, reflecting heightened uncertainty and option market growth. The same pattern emerged when COVID-19 hit in 2020. A sharp decline in the S&P 500 coincided with a spike in the VIX, as shown at the chart on the left, and the options volume surged to new heights on the onset of 2020. However, while the S&P 500 took 5 years to recover after 2008 financial crisis, it rebounded in just 3 months following the 2020 dip. As shown in the chart on the left, the black line represents the S&P 500's break-even point, which the index only reached in 2013. In contrast, the chart on the right illustrates how within just a year and a half, the S&P 500 doubled in value after its 2020 decline. And from both cases, I observed that short-term traders who panic sold during the dip lost money. Long-term investors who held their positions recovered. The high uncertainty of the market performances led to more implementation of options trading strategies, showing the surges in the option volumes. This is because investors realize that options can create profit and act as a hedging tool in times of high volatility. But during 2020, there was another surge that didn't occur in 2008, one in retail option traders, which prompted my research question: how has COVID-19 impacted the dynamics between retail and institutional investors of the options market? To answer this question, I first identified the characteristics of retail and institutional investors. Then I analyzed the option trading activity before, during, and after the pandemic. And finally, I compared the findings to determine which group dominated during the different periods. So who are retail and institutional investors? Institutional investors, defined by the FINRA Rule 2111B, are entities managing over $50 million in assets. Many of these investors, including banks, IRAs, and insurance companies, manage large pools of money from clients' funds with a set quota of return that is needed to be met in a certain time frame. As a result, institutional activities are marked by long-term strategies by utilizing longer expiring option contracts, as well as trading high volume and large cap stock options. And retail investors, on the other hand, are investors that hold assets under $50 million and has a way lower range that have collected of around $500. And most new retail investors are focused on quick gains, resulting in a speculative option trading behavior that is highly reactive to volatility. Thus, they tend to engage in short-term strategies with shorter expiring option contracts, such as zero DTEs, 0 days to expiration contracts, and small trade sizes due to affordability. Surges in option activity before volatility spikes can also serve as an indicator of retail activity. The methodology I used was that I conducted an empirical analysis using linear, multivariable, and lag regressions on 3 key variables. I used the VIX index as a proxy for market volatility and S&P 500 returns to represent market performance. My goal was to examine how these two factors impact the put-call ratio, PCR, the amount of puts bought relative to calls, which tracks investor sentiment since traders commonly buy put options as a hedging strategy when expecting a decline or surge in volatility. And additionally, I collected data on average daily options volume, ADV, option expiration dates, underlying assets, and trade sizes to provide further insights on option activity throughout the pandemic. And my findings were that pre-pandemic options landscape exhibited higher volumes of larger trade sizes and longer expiration dates, which associates with the characteristics I observed in institutional investors. Furthermore, there was little to no correlation between PCR, VIX, and S&P 500 returns, suggesting a lack of speculation and short-term strategies. This suggests a lack of retail activity, which was largely attributed to financial barriers such as high commission costs and low capital for investment, and also the complexity of options trading, which makes it inaccessible to many retail investors. And the pandemic, however, showed a shift of dynamics where the options market was dominated by retail activity. This is shown in the surge in smaller trade sizes and shorter expiration date volumes, and also there was a way more significant correlation between PCR and VIX index. But institutional activity still persists. And why is this the case? Commission-free and user-friendly platforms, social media, lockdowns, and government incentives that emerged during 2020 all served as a factor that lowered this option trading barrier for retail investors. And when I ran a linear regression on PCR and VIX during the pandemic, the relationship was clear that before volatility spikes, the amount of puts bought increases. The orange line, PCR values, fluctuate based on the movements of the blue line, the VIX index. However, the timing was off. The two lines didn't align perfectly, indicating that COVID-19 conditions resulted in this pattern where put option activity concentrates before volatility surges in volatility. Oh, sorry, before surges in volatility. But how long before? So I tested lagging the PCR values by various time frames, and with a 1 week lag, the PCR fluctuations were more aligned and the correlation became stronger. Another observation that has a connection with this is that there was a surge in weekly options trading during the COVID-19 era, suggesting that short-term speculation increased as traders reacted to recent market movements, potentially amplifying volatility and liquidity shifts in the options market. During the pandemic, the R-square value indicated that 20% of the 1 week lagged PCR fluctuations were explained by the pandemic volatility. This relationship was 10 times stronger than the pre and post-pandemic levels, where the R-square was less than 0.02, and the p-value was zero, almost confirming the statistical significance. And these findings highlight the strong presence of retail activity during COVID-19, with their options trading strategies closely tied to market volatility. In post-pandemic, the dynamic between retail and institutional activity was more balanced. ADV, average daily volume, is continuously growing, showing sustained interest in option trading. And short-dated options remain popular, but PCR and VIX correlation weakens, suggesting fading speculative behavior. This disruption is especially prominent during August 2024. So conclusions and implications. The pandemic reshaped the options market by democratizing access, driving significant and sustained growth. Retail and institutional traders now coexist, reshaping market dynamics. However, this transformation raises regulatory concerns on the oversight on retail speculation and how market rules will adapt with these evolving trading platforms. And looking ahead, the key question my research brings forth is how will regulators and institutions respond to this new normal? Thank you for viewing my presentation.
Thank you so much, Lindsay. A lot of insights here. I'm curious whether you think that things will eventually go back to what they were like pre-COVID, or do you think this is kind of like a new world that we're in?
Yeah, so that's why I named my research the new normal because ever since COVID, retail investors they didn't have any access to option trading because of all the barriers such as commission fees and also because of the complexity of options. But then now people start to get more exposure in the options market. They start to understand more about the risks of trading options, and I feel like in the future, there will definitely be more financial literacy in retail investors with this new exposure. And so this will be a there will be a continuously trend in retail option trading.
Very interesting. And do you think that this is something that you want to continue studying?
Yeah, because I'm really interested in option trading, and I hope to work in a hedge fund, because I feel like option trading and like finance, really it's kind of similar to science where they offer explanation of our world, and so basically, finance helps explain why businesses grow, government funds projects, and also there's monetary policies being implemented. And they all of these things relies on financial principles. And this explains why prices rise, why there's inflation, depression. And finance is not just about numbers. It's also about understanding risk, strategies, and human behavior. And I just find that really interesting.
A funny question, but that moment where you did the shift in 7-day lag and then you actually got like a p-value of zero. Like, how was that feeling? What was that moment like? Where you're like, oh my God, I found something.
Yeah, so when I was talking to my mentor, Clay Wagar, I was like, hey, here's what I got, but you can definitely see this shift where before the volatility spikes, the PCR spiked and they're
Yeah.
not really aligned. And so he was like, have you tried lagging the data you collected on PCR back by various time frames, like 1 month, 2 weeks, or 1 week? And I was like, no, I should try that. And that's what I did. And when I hit 1 week, that's like when I hit the jackpot.
Amazing. We actually have one question from the attendees. How has technology played a role in making the options market more accessible?
Yeah, so I talked about commission-free trading platforms such as Robinhood and also social media, but it's kind of like a whole different topic when I dived into this. But people, the reason why those companies such as Robinhood are able to provide commission-free trading platforms is because they have this pay for order flow, PFOF, and what it does is that like when users they place a trade, um, Robinhood, what they do is that they direct this trade um to the market makers, and market makers they try to match up what the asks of the users with a let's say they want to buy option, they find an option on the market and they buy the option, and there's this difference between the bid and the bid ask it's called a bid ask spread. So here's what the user is asking. Here's like, oh, the cost of the the asset that's being bought by the market maker. There's like a difference between them. And what happens is market makers they profit off of this bid ask spread and they give that a certain amount of that profit um to the uh brokers such as Robinhood, and that's how they generate revenue. And but this also incentivizes retail option traders to engage more in trading options and stocks because there's no commission fees, and so it just kind of acts like the cycle.
Well, thank you so much, Lindsay. I'm sure some people learned some stuff about options. I don't know how many high schoolers are out there learning about this. So thank you so much.
Yeah.